Here's a question nobody ever asks you. And I want you to actually think about it before you keep scrolling. What stage are you in? Not your income, not your job title, not how your Instagram looks or what car you drive, or whether you have a 401(a) that you technically contribute to but have never actually looked at. What financial stage are you operating in right now? Because here's the thing that took me an embarrassingly long time to figure out. Being broke and being wealthy are not 2 points on a straight line. They are not a dial that you gradually turn up. There is no smooth, continuous progression where you start at zero and slowly become rich. There are four distinct stages. Each one has a completely different operating logic. Each one has a different relationship with money, a different set of threats, a different set of priorities, and a completely different psychological experience of daily life. And here's what almost nobody in the personal finance space talks about. Most of the advice you've ever received, the budgeting tips, the investment strategies, the just cut your expenses wisdom is stage specific. Advice designed for stage 3 is actively harmful in stage 1. Behavior that is perfectly rational in stage 2 is financially suicidal in stage 4. You have probably received advice designed for a stage you are not in, and that mismatch between where you are and the guidance you've been given might be the single biggest reason your financial life hasn't moved the way you expected. Today we are fixing that. My name is Slime Johnson. This is Slime's Wealth Academy, and today we are mapping the entire journey, all four stages, the exact map that defines each one, the psychological experience of each one, and the specific moves that get you to the next one. By the end of this video, you will know exactly where you are and you will know exactly what to do next. Let's go. If you're someone who feels like you're doing the right things financially, but still can't quite figure out why your situation isn't improving, if you've gotten conflicting advice from different sources and can't tell which of it actually applies to you, make sure you hit that subscribe button and give this video a thumbs up if it helps you out. Because today we are giving you the map, not generic financial advice. The specific framework for understanding where you are right now, what the rules are at your stage, and what single most important move gets you to the next level. This is the video I needed 10 years ago. So stay with me. Part 1, the history lesson. How America lost the map. To understand why most people can't locate themselves on the wealth spectrum, we need to go back to 1971, August 15, 1971. President Nixon appears on national television and announces that the United States will no longer exchange dollars for gold. The Bretton Woods system, which had anchored global currency values to the dollar and the dollar to gold since 1944, is over. Nixon closes the gold window. Most Americans watching that broadcast had no idea what it meant. The ones who did, economists, traders, central bankers, argued about the implications for years. What it meant practically was this: the rules of money had fundamentally changed, and almost nobody had been given the new rule book. The decades that followed produced something economically unprecedented: a consumer credit explosion. Before the gold standard ended, if you wanted to borrow money, you needed a bank that had it, and banks could only have so much of it. After 1971, the money supply could expand essentially without limit. Credit card issuance exploded from 16 million cardholders in 1970 to over 200 million by 1990. Consumer debt as a percentage of disposable income rose from 62% in 1975 to over 130% by 2007. Here's why that matters for what we're talking about today. The credit explosion fundamentally blurred the line between stages. It made stage 1 feel like stage 2. It made stage 2 feel like stage 3. It created the illusion of financial progress without the underlying math to support it. A person with a $60,000 income, a $400 car payment, a $1,500 mortgage, 3 credit cards, and a 401(n), they barely contribute to genuinely cannot tell you what financial stage they're in, because the debt is masking the reality. The personal finance industry grew up inside this blurred landscape. It produced advice that assumed everyone was operating from a position of relative stability: budget better, invest more, diversify your portfolio. Advice that made complete sense if you had a financial foundation. Advice that was genuinely useless and sometimes actively harmful if you didn't. A 2023 report from the Financial Health Network found that only 31% of Americans are financially healthy by their definition, able to manage day-to-day finances, maintain savings, borrow responsibly, and plan ahead. 69% of Americans are either financially coping or financially vulnerable. 69%. 2 out of every 3 people you know are operating without a stable financial foundation, and most of them have been handed advice designed for the 31%. That's the gap. That's what we're filling today. Part 2, the 4 stages. The complete map, let me give you the framework. 4 stages, clear threshold, specific math, no jargon. Stage 1, survival mode defining characteristic. Your income does not reliably cover your expenses. This is the stage most people don't want to admit they're in. Because the cultural script says that if you have a job and you're paying your bills, you're not in survival mode. That's for homeless people. That's for people in real poverty. That's wrong. And that misidentification is keeping millions of people stuck. Here is the financial reality of stage 1. You are one unexpected expense away from a crisis. One $400 car repair, one $300 medical bill, one missed paycheck. Any of these tips you into debt, overdraft, or borrowing, which starts a cycle that is very hard to break. According to the Federal Reserve's 2023 report on the economic well-being of US households, 37% of Americans could not cover a $400 emergency expense using cash or its equivalent. 37%. That is stage 1, regardless of income. And here's the part that makes this stage so insidious. Stage 1 is expensive. We covered this in a previous video on the poverty premium. Overdraft fees averaging $420 per year, payday lending fees averaging $520 per year, insurance premium gaps, grocery premiums. The structural cost of being in stage 1 is estimated at over $3,000 per year in unnecessary fees and premiums. Stage 1 is not just uncomfortable, it is mathematically extractive. The psychology of stage 1, your prefrontal cortex, the long-term planning center, is running at reduced capacity because your amygdala is in near constant threat response. Research from Harvard Kennedy School shows that financial insecurity measurably reduces cognitive bandwidth by the equivalent of 13 IQ points during periods of active stress. You are not making bad decisions because you lack intelligence or discipline. You are making suboptimal decisions because your brain is running emergency software. The one move that gets you out of stage 1. Build a $500 to $1,000 cash buffer. That's it. That single buffer is the firewall between you and the entire predatory alternative finance infrastructure. It eliminates the overdraft trigger, the payday loan trigger, and begins the process of reducing cortisol enough for your prefrontal cortex to come back online. Do not start investing in stage 1. I know that sounds counterintuitive, but here's the math. A $35 overdraft fee represents an effective interest rate of 10,000% APR on a $40 shortfall. No investment on earth returns 10,000%. Your first financial priority in stage 1 is to eliminate that drain entirely. One $500 buffer in a separate labeled savings account, emergency only, changes your entire operating environment. Timeline to exit stage 1. With $25 to $50 per week saved consistently, most people can build the initial $500 buffer in 2 to 5 months. The psychological shift begins almost immediately. Stage 2, stability mode defining characteristic. Your income reliably covers your expenses and you have a basic emergency fund, but you are not building wealth. Stage 2 is where most middle class Americans live and where most of them stay for decades. Here is the financial reality of stage 2. You are not in crisis. You are not one emergency away from disaster, but you are also not moving forward. Your money is managing your life, not building your future. The 401(n)A exists but is underfunded. The emergency fund covers 1 month, maybe two. The car payment is current, the mortgage is current, but the net worth isn't growing in any meaningful way. Here's the number that defines stage 2. Your savings rate is under 10% of gross income. According to the Bureau of Economic Analysis, the average American personal savings rate as of 2024 is approximately 4.1%. 4.1%. That is stage 2 or worse for the majority of the country. What's keeping people in stage 2 is not income. It's a specific documented psychological phenomenon called lifestyle normalization. Every time income rises, expenses rise proportionally to match. The apartment gets upgraded, the car gets newer, the dining gets nicer. The income went up, the savings rate stayed flat, the net worth barely moved. A salary finance study found that 33% of Americans earning over $100,000 a year live paycheck to paycheck. Not because $100,000 isn't enough, because lifestyle inflation consumed the entire raise before the savings rate could capture it. The psychology of stage 2, the threat response of stage 1 has faded. You're comfortable enough that the urgent motivation to change is gone. But you haven't yet crossed the threshold where compound interest becomes visible and self-motivating. You are in the motivational dead zone, the trough between the fear that drove stage 1 action and the math that will eventually drive stage 3 momentum. This is the most dangerous place to be comfortable because fine is the enemy of free. The two moves that get you out of stage 2. First, increase your savings rate to at least 15% of gross income, not all at once, 1% every 6 months. At $60,000 gross income, going from 4% to 15% savings is the difference between $2,400 per year and $9,000 per year going toward wealth building. That's a $6,600 annual swing. Invested at 10% over 20 years, over $380,000 in additional wealth. Second, capture every income increase before it reaches your lifestyle. Make a rule, written down, non-negotiable, that 50% of every raise goes to investments before you spend a dollar of it. Your lifestyle can grow with your income, but at half the rate. The exit from stage 2 is not a crisis, it's a decision. A boring, unsexy automated decision that you make once and execute forever. Stage 3, accumulation mode defining characteristic. You are consistently building wealth. Your savings rate is 15% plus and compound interest has become visible and self-reinforcing. Stage 3 is where the math starts doing the motivating. Here's the financial reality of stage 3. You have crossed the threshold, somewhere around $50,000 in liquid investments, where compound interest becomes tangible. At 50,000 in a broad market index fund earning 10%, your account generates $5,000 per year in returns. That's $460 a month passively. That's a car payment covered every month by money that used to not exist. Here's what most people don't realize about stage 3. This is where financial identity changes. Below the threshold, most people think of themselves as someone trying to save money. Above it, people start thinking of themselves as investors, as builders. And identity based behavior is the most durable kind. The moment you see yourself as someone who builds wealth rather than someone who manages expenses, every daily financial decision changes. Stage 3 is also where the most common and most expensive mistake happens. People mistake accumulation momentum for permission to take on more risk. They discover options trading on TikTok. A friend texts about a crypto opportunity. The boring index fund starts to feel like it's for people who don't know any better. The data on this is unambiguous. A 2022 University of California Berkeley study found that individual investors who actively traded individual stocks underperformed simple index funds by an average of 3.8% per year, consistently over 15 years. On a $200,000 account, the difference between 10.5% and 6.7% annual return over 20 years is 356,000 versus 239,000. That's $117,000 paid in the form of underperformance for the privilege of feeling clever. The bottom of stage 3 is a feature, not a bug. The whole job is to not mess up a process that is working. The two moves that keep you in stage 3 and push you towards stage 4. First, contribution rate obsession. Every raise, every bonus, every windfall, a pre-committed percentage goes directly to investments before you see it. If you're earning $80,000 and investing 15%, 12,000 per year, moving to 20% means 16,000 per year. That incremental 4,000 invested cent over 20 years, over 229,000 additional wealth. Second, protect the compounding. Do not rate the account. Do not make concentrated bets. Do not try to time the market. A Dalbas study found that the average equity investor earned 6.4% annually versus the S&P 500's 10.15% over 30 years, entirely because of behavioral mistakes made during volatility. Every time you interfere with the compounding process, you pay for it in years, not just dollars. Stage 3 milestone, $300,000. At $300,000 invested at 10.5%, your annual returns, 31,500, exceed the average American's annual contribution to the retirement account. You have crossed escape velocity. The math is now the primary engine of your wealth. You are the co-pilot. Stage 4, infinite runway mode defining characteristic. Your passive income from investments exceeds your living expenses. Work is optional. This is the stage that sounds like a fantasy. It is not a fantasy. It is a math problem with a specific calculable solution. Here's the financial reality of stage 4. The 4% rule, derived from Trinity study and widely accepted by financial planners, states that a portfolio can sustain a 4% annual withdrawal rate indefinitely, adjusted for inflation, with extremely high historical probability of not running out over a 30-year period. This is based on over 100 years of market return data. What this means practically: to fund a 50,000 per year lifestyle indefinitely from investments, you need $1,250,000 invested. To fund $75,000 per year, $1,875,000. To fund $100,000 per year, $1,100,000. These numbers sound large. Let's look at the journey to get there using what we've built across this video. A 25-year-old who invests $500 per month at 10.5% annually reaches $1 million by approximately age 57. They've contributed roughly $192,000 of their own money. The market contributed the other $808,000. At $1,000,000 under the 4% rule, they can withdraw $40,000 per year indefinitely, while the remaining balance continues to grow. If that same person increases their contribution by $100 every 3 years, keeping pace with inflation and modest income growth, they reach $1,250,000 by approximately age 55. The $50,000 infinite withdrawal, funded indefinitely. That is not a fantasy. That is a 30-year commitment to a boring automated system. Starting at stage 1, exiting stage 2 without getting comfortable, staying disciplined through stage 3, and arriving at stage 4 with a portfolio that generates more money per year than most Americans earn at work. The psychology of stage 4. This is where the shift Charlie Munger described becomes complete. The first $100,000 is hard because you are fighting your biology. The first $300,000 is hard because you are fighting lifestyle inflation. The first 1,000 is hard because you are fighting the temptation to interfere with a process that doesn't need you anymore. Stage 4 is not the end of financial discipline. It is the beginning of financial philosophy. People who reach stage 4 successfully are almost universally the people who never changed the habits that got them there, even when they no longer had to keep them. The one move in stage 4. Don't break it. That's the whole job. Don't raid the portfolio for lifestyle upgrades. Don't take concentrated risks that can't be recovered from. Don't change the asset allocation dramatically just because you feel safe. The portfolio that got you to stage 4 is the portfolio that keeps you there. Honor it. Part 3. The twist. The stage making problem. Here's the most important insight in this entire video. And it's one I've never seen spelled out clearly anywhere else. Most of the financial advice you've ever received is stage 3 advice delivered to stage 1 and stage 2 people. Max your 401ing stage 3 advice. Correct if you have a $500 emergency buffer and a stable savings rate. Incorrect if you're getting hit with $35 overdraft fees because your account runs lean. The tax benefit of the 401na contribution doesn't outweigh the 10,000% effective APR of the overdraft. Invest in index funds for the long term. Correct in stage 3 and 4. Partially correct in stage 2. Not the priority in stage 1, where the immediate return on a $500 cash buffer is higher than any investment on earth. Build a diversified portfolio. Stage 3 and 4 advice delivered to someone who is in stage 1 or 2 and doesn't have a portfolio yet. The financial content industrial complex, YouTube, Instagram, TikTok finance, is almost entirely stage 3 content. Because stage 3 content is aspirational, it features large numbers. It makes people feel good about the future they could have. It gets clicks. Stage 1 and stage 2 content is harder to make viral because the truth of those stages is boring, incremental, and sometimes uncomfortable. Build $500. Don't touch it. Increase your savings rate 1% every 6 months. Don't lifestyle inflate your raise. Nobody wants to click on that video. But that video is the one that changes lives. Part 4, the present day. Knowing your stage right now. Here is how to identify your stage with precision. Right now, today, ask yourself 3 questions. Question 1. If I had an unexpected $400 expense tomorrow, could I cover it from cash savings without borrowing or going into overdraft? If no, you are in stage 1. Full stop. Every other financial priority is secondary to building a $500 to $1,000 cash buffer. If yes, proceed to question 2. Question 2. What is my current savings rate? The percentage of my gross income going to savings and investments. Under 10%. You are in stage 2 regardless of income level. Your single priority is to increase this rate, capture income increases before lifestyle inflation claims them, and automate the process. 10% to 20%. You are in the upper range of stage 2 or early stage 3. Your priority is consistency, contribution rate growth, and avoiding the lifestyle inflation trap. Over 20% with growing investment balances. You are in stage 3. Your priorities are protecting the compounding, avoiding behavioral mistakes during market volatility, and pushing toward the $300,000 escape velocity milestone. Question 3. Does your passive income from investments cover any meaningful percentage of your living expenses? If your annual investment returns generate enough to cover even 10% to 20% of your expenses, you are approaching stage 4. Your priority is protecting the portfolio, maintaining discipline, and targeting the specific portfolio size that funds your lifestyle under the 4% rule. Part 5, the honestic, Sanek and Crunk environment look. Let me be straight with you about a few things. The stage framework I've described is mathematically sound. The psychology is documented. The historical data behind it is real. It's also true that we are in an environment with specific characteristics that matter for each stage. For stage 1 and 2 people, high yield savings accounts are currently paying 4.5% to 5%. This is the highest real yield on safe cash savings in over a decade. Every dollar in your emergency buffer is earning real returns while it sits there protecting you from the predatory fee infrastructure. Build the buffer. Park it in a high yield savings account. Earn 4-5% while it protects you. For stage 3 people, equity valuations are stretched. The Shiller-Cape ratio at approximately 34 to 35 times earnings against a historical average of 17 suggests that forward returns over the next decade may run 6% to 8% rather than 10.5%. This doesn't change the framework, it changes the timeline slightly. The stage 3 playbook, consistent contributions, broad diversification, behavioral discipline, no interference, is exactly the right playbook regardless of valuation environment. You just need to be honest about timeline expectations and not assume 10.5% returns going forward. For stage 4 people, the 4% rule was designed around historical market data that included both high return and low return decades. In a potentially lower return environment, some financial planners recommend a 3% to 3.5% withdrawal rate for additional safety margin. A Fund 500,000 portfolio at 3.5% generates $52,500 per year. The math still works, it just requires slightly more runway. For everyone, the labor market remains relatively tight with unemployment hovering around 4.1%, below the 50-year historical average of 5.7%. If income growth is available through negotiation, skill development, or employer change, and in this environment, it often is, that income growth is the fastest lever for moving between stages. A $10,000 income increase captured before lifestyle inflation reaches, it does more for your stage progression than almost any investment optimization. Here's what I need you to carry out of this video. You are in a specific stage right now, not a vague financial situation. A specific, identifiable, operationally distinct stage with its own rules, its own threats, its own psychology, and its own single most important move. Identify it, not the stage you want to be in. The stage you are actually in. The one that answers honestly to the three questions. The one that matches your savings rate, your emergency buffer, your net worth trajectory. And then this is the part that sounds simple and is the hardest thing in personal finance. Do the one thing that stage requires. Not all the things. Not the stage three things if you're in stage one. Not the investment optimization strategies if you don't have a $500 buffer yet. The one thing. Stage one, build the $500 buffer. Everything else waits. Stage two, get to 15% savings rate. Capture the next raise before lifestyle does. Stage three, protect the compounding. Push toward $300,000. Don't interfere. Stage four, don't break the machine. That's it. Four stages, four priorities, one move per stage. The people who move through all four aren't smarter than you. They aren't luckier. They aren't better with money in some innate, God given way. They just knew what stage they were in. They did the one thing that stage required. And they didn't let anyone or any financial content algorithm talk them into doing stage three things when they were in stage one. Know your stage, do the work, advance. The map is yours now. If this video helped you identify where you are and what to do next, hit that like button right now. It genuinely helps this channel reach the people who need this most. Subscribe to Slime's Wealth Academy if you're not already here. Every week we break down the real mechanics of how money works and how regular people can use them. Drop a comment right now. Which stage are you in? Be honest. Stage 1, stage 2 grinding, stage 3 accumulating, stage 4 tell me. I read all of them. And if you're in stage 1, I need you to know that's not a verdict, that's a starting point. Every person who ever reached stage 4 started there. If you've got someone in your life who needs this framework, who's been getting the wrong advice for their stage, send them this video. It might be the most useful thing you do for their financial future this year. I'm Slime Johnson. This is Slime's Wealth Academy. Regular people, real wealth, no gatekeeping. See you in the next one.